Welcome back. Today we're talking to Craig Racine from Gyrostat Capital Management. Gyrostat has an interesting strategy. It's been going for 10 years and it really is aimed at protecting the downside, of providing protection in volatile times and volatile markets, and haven't we had some of those, whilst at the same time providing quarterly income. Craig, good afternoon.
Hi, Chris.
Nice to see you again. Tell us more about how you achieve this protection while still providing an acceptable level of return from equities.
What we're doing in portfolio construction is ensuring that as a defensive asset, not only does it provide the regular income, but reliably increases on market falls. So when you add it to a portfolio, overall, you'll have less risk, higher income, and higher returns. So that's where we fit. The way we do that is we invest in around 25 assets, the ASX 20 or thereabouts, plus the index in Australia for income. And we also have a small portion in the lowest cost protection that's always in place. Now that protection increases in value when markets fall. We always have a bit extra protection, so that's where the accelerated returns come from, and which we can sell on market falls very reliably and then return that to our investors.
So when you say protection, you're using exchange traded options, puts and calls?
Yes, we are. Ours is a bought strategy. So essentially, we've got a very sophisticated system that brings in all of the option pricing and can find the lowest cost protection. We set a point on the curve where one is a cheapest price or the same payoffs. But what we're able to do is then see that the profit potential is far greater using those particular option series.
Now, options can be risky, but you're only buying options, so you're long options, which means that your maximum risk is either time decay or the option actually expiring. So you don't have that unlimited risk that a sold option has. Is that correct?
Oh, that's correct. The key is always has been, how can you keep the protection always in place, yet achieve those objectives we started of reliable profits on the downside and regular income. So what we're actually doing is buying and holding the underlying stocks, and it's the active management of the options that makes having it always in place cost effective. And you're quite right, it's just a very small defined cost that you've seen over 10 years. We've never ever lost more than 2.something%. So we can manage it within acceptable parameters as well.
So with a maximum downside of less than 3%, and then in particular, considerable upside when the market becomes volatile as it did earlier this year.
Yes. At one stage we were running at 12-month returns were greater than, I think, 18 or 19%. Now that's unusual for us, but it was a particularly volatile period when COVID came. At the moment we're running at around 12% annualised returns, and the more the volatility in the market, the higher our returns. As volatility, if it was to fall, our returns will be lower, but still significantly higher than many of the other defensive assets.
Sure.
And importantly, you've always got in place, if there is a volatile event, you can reliably get a greater return.
And when you're talking about regular income, quarterly income, I believe.
Yes, it is. Yes, we're able to pass through the dividends from the two different cycles in Australia. So you have some of those that are paying in March and some in June or thereabouts. So we're able to pass those through. In various events, like when the banks had zero dividends, we can also generate income from our little bit of extra protection, which converts to cash, which we pass through. So that's why last year we're actually generated our best year ever, both in terms of income and returns for our investors.
Craig, you mentioned that in your view this fits well into a portfolio, and we would tend to agree with that. I mean, we're not great believers in investing in a single fund or a single asset, but this blends very well because of its low correlation with many other more volatile funds.
Yes, that's how we've designed it as an add-on to what our investors are currently doing. So we've seen many investors will use a variety of the growth strategies that you've spoken of, but it's very difficult with interest rates so low to get some sort of benefits and income out of those defensive assets. So what we've done with our various enhancements is say, let's have the protection always there. How can we really add people? What do they want? They need something that makes reliable money if markets falls, and all the way through the cycle gives you a higher income. And that's what we've achieved. But we're blended on that, we're that defensive side only. And we've seen many investors use completely different strategies for their growth assets. That's not what we do. We're trying to help in the overall picture. By blending those various strategies, you get something that's less risk, higher income, higher return.
And Craig, the fund's not available for retail investors, only open to wholesale investors, is that correct?
We are wholesale under our AFSL. We are in fact, we've signed with a managed discretionary account advisor. So in the extent that an advisor with an MDA license wanted to invest in our fund, we are available under product disclosure statement in that limited circumstance.
Okay. Craig, as always, great to talk to you. Thank you very much. Good luck and stay safe down in Victoria.
Thanks very much, Chris.